Okay, a very good weekend to everyone. For my 51st video for Growing Your Tree of Prosperity, I will be repeating a talk that I made in the SGX auditorium. There is a Dr. Wealth event where I spent some time talking about how I lived off dividends for a decade. And I thought it would be a waste if I do not go over the slides again on this YouTube video. All right. So let's go. Okay. All right. So this is who I am. Okay, and I'm going to talk a little bit about the situation in the 2000s when I first started out as an IT systems administrator, and I'll then talk about my strategy to become financially independent, and then I'll spend a little bit of time talking about how dividends investing work, uh, and how much do you need, and then I'll share with everybody some useful starting portfolio positions that you can try. All right. So you find that a lot of these slides are consolidated from some of my other YouTube videos. All right. Okay. So my story is that I spent some time in IT outsourcing, where actually I was indeed working as an account technical lead under HP in SGX. All right. And in the 2000s, after the dot-com crash, Singapore faced an influx of very cheap, competent software labor from other parts of Asia. And at the same time, there is an outsourcing wave going on. Companies are releasing their staff to an outsourced provider, and then that outsourced provider would then provide IT services to the company. And for me, what really affected me was I became an outsourcing professional, and then one fine day, I received an email saying that a European ex-colleague committed suicide when his contract was not renewed, when his work in Belgium was outsourced to Czechoslovakia. All right. And as a result of that, I wanted to find a way out of my struggles in the IT sector. So I sort of stopped my Microsoft, Cisco certifications, and I pivoted all the way into finance, where I would spend my evenings just studying the CFA very extensively before passing all exams in 2003. And I think the paper in the Financial Analyst Journal that changed my life is the paper that says that higher dividends equals higher earnings growth. And this is when a group of quants, right, Clifford Asners and Robert Ardert, who are billionaire founders of AQR Capital Management, they discovered in the year 2003 that companies that gave out a dividend tend to be run by more down-to-earth managers. They don't sit on a lot of cash. So over time, these companies grew faster than companies that kept their money and retained earnings for themselves. So that's a very counterintuitive kind of finding compared to the rest of my CFA syllabus. And that gave me the courage to actually begin liquidating my unit trust and putting it into dividend stocks. And the game that I wanted to play is exactly what the FIRE movement today talk about. I have basic expenses as a bachelor. I'm trying to build my investment income so that I can live on my basic expenses. And the whole point is to reach this point of singularity called the crossover point, where your family expenses and your own expenses is covered by the dividends, but you can continue to work and you can farm the full amount of your take-home pay back into the stock market. And then your money would then snowball very rapidly from that point onwards. And the journey to become a millionaire will be shortened tremendously if you can get this snowball, rolling in front of you, right? So how did I manage to reach crossover point at the age of 32, right? There are three things that need to happen, right? First, you need to earn more money. Secondly, you need to save more money. And thirdly, you need to figure out how to invest better. All three need to happen at the same time for you to succeed in financial independence, right? Otherwise, it will be very slow, okay? And most people do not succeed in financial independence because they cannot get all three aspects of their lives working at the same time. So the first strategy I need to figure out is how to earn more money. So I maxed out my overtime. I raised my take-home pay by about 40% because I spent my weekends in the data center. So I brought my CFA textbooks to the data center to study finance while my backups ran, right? Then I had to load and unload the backup tapes. Made a lot of money doing that. Okay, Gen Z, you're better than me. Okay, you can consider overemployment, signing employment contracts with one company by the day and maybe one crypto company in Dubai at night to develop their blockchains for them, right? If you do this and you don't get caught, you can make a lot of money. Okay, you can make a lot of money, and you can double your standard of living just by doing that. Okay. Of course, making money is not enough. You need to save this money, right? And for me, I continued to live like an undergraduate, right, for about 7 years after graduation. I track my expenses manually using an SAF notebook. It's very powerful because everything's manual. If you make a lot of tiny purchases, you have to create more entries, and so you will reduce your expenses throughout the day. Okay, and fortunately, because I'm an IT professional, it's not a very client-facing kind of career path. I can dress like a slob, right? The backups have to run, of course, right? Accounts need to be created. People who are departing, their accounts need to be deleted, right? That's the kind of life of an IT worker, right? Close to 25 years ago. And I've said this before and it's upset some people. I didn't date anyone until my passive income exceeded $600, right? Yeah, and I see a future video specifically on this topic about dating, the FIRE movement, how to synchronize your move towards financial independence versus looking for a date, something which I think my 92% of male audiences might actually enjoy. Okay, and obviously I have to have a killer strategy to invest my money. And sometimes when you do this carpet bombing tactics for dividends, that means you find anything that gives you 5% dividend, you add a small amount into your portfolio, right? It could be $1,000. But if you can see that the free cash flow is high, the payout ratio is relatively low, and dividends are growing, then you can multiply it by a factor of 10, right? And the SGX is designed for this. You've got banks, REITs, business trusts, and your Singapore depository receipts to enable like the formation of B stocks in your CDP account. And actually, I prefer CDP. It's very expensive to trade there, but the CDP pushes money into your bank account on the payable date, right? And, DBS account holders will get it at around 5:30 p.m. in the evening. So very, very powerful. And then I produce some backtested results where if you buy the 8 REITs in STI, the returns are not too bad for the past 10 years, 7.85%. Obviously, the banks have done better at 13.42. I expect this to reverse itself when interest rates begin to fall. Okay. Now, how do we know that dividends investing works? Right? Dividends investing works in Singapore, right? And you can find evidence in a book by Tariq Dennison entitled 10 Ways to Invest. Okay. And you find that if you were to target dividend stocks in Singapore, your median 20-year CAGR from 1975 to 2021, you get 9.7% returns, right? If you go for something without dividends, your return is only going to be 2%, okay? And if you consider the worst 20-year CAGR, your compound annual growth rate, your dividend stocks would have prevented disaster by losing only 0.6%, whereas the companies that did not give out a dividend, they would have lost 17.7%, right? And because of this rich evidence, right, of how successful dividends investing is in Singapore. So now when you read the press about this idea of MAS trying to stimulate the markets, right, one of the things they struggle with is to make our growth stocks cool in Singapore, right? I find that very challenging. How do you make growth stocks cool in Singapore when people like me that's been investing for 2 decades or more will never put my money into growth if I can help it? Right? Why do growth? When I can find something that gives 5 to 6% dividends every year, without any drama, with a very low volatility, so that I can talk about my life as a YouTube influencer, and I sleep well at night, right? So I think that's a struggle for our very expensive scholars, all right, to think about. Okay. All right, so how much do you need? If you want a portfolio that gives you $2,000 on average every month from your dividends, then your portfolio size is 2,000 multiplied by 12 divided by 0.05. You need $480,000 to reach financial independence. because $480,000 multiplied by 5%, every year it's about $24,000 a year, right? So this is a very large amount that a single person needs to get out of the rat race, right? And I always tell my audience that this number looks very intimidating. So instead, why don't you focus on a small target, right? If you can reach the small target, you can reach the big target. So I always talk about $100 a month. And to get $100 a month, you need $24,000 to do that. So you build a $24,000 portfolio, it gets you $100 a month. That gets you your Netflix, your Disney Plus, and your Prime Video subscriptions. It automatically pays for it every month. So you can see an improvement in your standard of living, right? But obviously the preferred approach is to try to use your extra $100 every month to get your next $100 a month. Okay? Right. So for people who are absolutely just starting out in the local stock markets, you're interested in investing in Singapore, what's a good starter portfolio, right? I've deliberately made this a portfolio of stocks. The reason is because the STI ETFs, there is an expense ratio when you buy it, right? And if you have an expense ratio when you buy something, somebody else makes a certain amount of money, and over time it compounds, right? You can lose a lot of money doing that. So why not consider actually giving yourself the motivation to take action, to sign up for a traditional broker or custodian broker, and to learn how to actually build a portfolio personally, right? As a life skill, okay? And if it's a life skill, you don't need to start with many stocks, right? This is not a diversified portfolio, but I'll give you the quantitative reasoning as to why it's a very good starter portfolio for a lot of like retail investors who want to delve into local stocks the first time. First is DBS, highest projected return on earnings across the three big banks, also has the highest dividend yield, right? So very good place to start. Only problem is you need about $4,000 to $5,000 to get a 100 share position. Okay. When interest rates go up, you do well. When interest rates go down, obviously your net interest margin will be affected. But you can rely on wealth management fees when these interest rates go down. So it's not so bad, right? But obviously you're not relying on DBS solely, right, to create your rookie portfolio. There's also Fraser Centrepoint Trust, where you can actually visit these suburban malls to see how well your buildings are doing, like Causeway Point. Fraser Centrepoint Trust preserved a lot of value during the pandemic and is among the more stable blue chip REITs in the STI, right? Obviously, there's some risk, right? Cinemas shutting down, people going to JB for retail. But when interest rates go down and DBS starts to suffer, Fraser Centrepoint Trust might be able to hold the fort while that's happening. So that's what you want to do, right? You want to have your investments offset each other, right? And thirdly, Netlink Trust is a business that operates fiber networks, right? It's affected by higher interest rates, and the prices, there is a little bit of policy risk because it's controlled by regulators, but very super stable kind of business, very boring, it lacks drama. When combined together, these three stocks, even though I wouldn't say that it is well diversified, it gives a beginning investor the confidence to be able to expand the portfolio later to about 20 to 60 stocks like what I have, right? This is a very good starting position. Imagine you're playing chess, you know, it's like the Queen's Gambit, right? This is a good starter position for you to go for, right? Now, why do I have the courage to talk about combining these three stocks in equal shares? Because I've built a correlation table around it. When you look at the correlation between these counters, the correlation is below 0.5. So there is diversification, even though I reason that it might lack adequate diversification, but you know, the correlations between these stocks is very low, right? Sometimes I would argue that the correlation is lower than maybe US stocks and bond ETFs, okay? And if you look at the performance, excellent, right? These three stocks in equal shares did a 10% return for the past 10 years compared to the STI ETF, right? So why not consider this, right? Before you want to open an account, you know, with some strange, maybe robo company that it's ludicrous, right? Companies are waiting for the STI to hit 4,002 to launch an STI ETF, right? And the price to earnings ratio is already 13.11, right? Yeah, why not just short circuit that process and learn how to build a tiny little portfolio so that you can feel like a fund manager and you feel that you're in greater control of your financial destiny, right? Whatever I'm suggesting has obviously a higher Sharpe ratio than the STI ETF, okay, and all dividend yields are above 5% when I created the slide, all right? So it has superior dividends yields as well, okay? All right, so a little bit on some miscellaneous points on living on dividends for a decade is that remember that FIRE consists of three actions. I took action on all three fronts, right? Earning more, saving more, and investing better, right? And when I started to invest better, I zoomed in on dividend stocks because of a research paper I read for the Financial Analyst journal when I was studying for the CFA, right? So there is some backing based on what I'm trying to do. Now, obviously, I took action. I invested in local stocks when it was unpopular for many years. I'm not a fair-weathered friend, right? When during the great financial crisis, I kept putting my money into local stocks, and all these years of mockery of people that invest in Singapore and all that's finally starting to pay off, right? So while I can quit at age 32, I carried on working for 7 more years so I can significantly reinvest my dividends, right? And I continue to be frugal and I take public transport even today, right? And that is the end of my presentation in the SGX auditorium. It's an event that I did with under Dr. Wealth. Okay. If you guys want to know a little bit more about what I do, just Google ERM intro, take the first link, and you can visit my next early retirement masterclass. And I will talk a little bit more, all right, about my life. And that's all I have for you. Thank you very much.